Hi, it's Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives. Some of the most common questions clients ask advisors revolve around retirement and succession planning. How should I save for retirement? Will I have enough money to retire? Will I be able to leave something behind for my children or for philanthropic causes? New research from Dimensional addresses those questions. They did a study that found that investors who tilt towards value, size, and profitability in their equity allocation are likely to enter retirement with significantly more assets, sustain their retirement spending longer, and to leave behind larger bequests than with a standard broad market index portfolio. Given the popularity of broad market indexing, the findings have implications for advisors. And joining me to talk today about this research is Mathieu Pellerin. Mathieu is a senior researcher and vice president in Dimensional's Charlotte office. He conducts research on goals based investing with a focus on retirement and works closely with clients to translate research insights into solutions that address their needs. So, Mathieu, tell me a little bit more about your career path and what led you to work at Dimensional.
Well, first of all, thank you, Bob, for having me on. This is a paper that we're all very excited about at Dimensional. So I'm happy to get a chance to share the results with your audience. But to your question about my how I got to be at Dimensional, it's been a sinuous path. But I'm just going to start, I think, with my PhD experience. I'm a Brown economics PhD. So initially, I wanted to do the standard thing, which is to become a faculty member. And my areas of interest in grad school were just long term economic growth, so more stuff that's academic in nature. But something happened. I had an enormous amount of fun in my econometrics classes, which led me to specialize in that and have a more statistical, quantitative background. So that was pretty cool. And in parallel, I always had a kind of lay interest, if you will, in personal finance. So reading The Intelligent Investor, Warren Buffett's letter to his shareholders every year, that kind of stuff. So eventually I realized that I didn't want to go to academia. So I was looking for firms that weren't doing kind of traditional active stock picking on one end, but I didn't want to do stuff like high frequency trading or pure statistical strategies that had no economic content to them. So there's a few companies that had that kind of middle ground where you blend the quant stuff with the economic intuition. And after doing some digging, I saw that obviously Dimensional was obviously a good choice. So long story short, here I am.
Wonderful. Well, I sent one of my daughters to Brown. It's a terrific school, and we enjoyed the 4 years she spent there as an undergraduate, and then she also did 1 year in graduate study there. So let's start off by having you explain the idea behind this research, what inspired it, and what are the key points that advisors and their clients should be able to take away from it.
Let me start by with a little preface. The answer is much more general than what I'm going to start with, but I do want to give you the inspiration, which was originally quite narrow for what prompted this research. So I was sitting at a conference, listening to a talk, and what the speakers were talking about is a set of results, just looking at different portfolios and how those portfolios were able to sustain spending in retirement. And one of the main points of that presentation was that by adding a small sliver of private assets, private equity, private credit, real estate, stuff like that, you could have a massive influence on your probability of sustaining your retirement spending. So now, of course, I'm kind of questioning what are the assumptions that lead to those results. And eventually, the presenter gets to his slide about this capital market assumption. And there's a line in that table, which is literally private equity, expected return 12%, and volatility something like in the high 20s. And the first thing that jumped to my mind, obviously, is this is small cap value in terms of returns characteristic. And my thought was, well, if you have a set of strategies with public securities, liquid stuff that approximate that pattern of behavior, you would expect to see the same kind of benefits. So that was the inspiration for that research. But what happened is we ended up looking not at the combination of assets, but rather a whole combined equity portfolio. So really, what the study looks at is someone who follows a dynamic asset allocation over the entire life cycle, mix of bonds and stock. What happens when you switch from having a plain market allocation in the equity sleeve and holding instead a systematic active portfolio that pursues size, value, and profitability? So instead of having your market portfolio in one corner and having a 10% small cap value in one corner, you kind of have an integrated portfolio that has that moderate to light amount of tilts. And the big findings, obviously, I started out based on my inspiration with the failure rates, and I found some benefits there. But what ended up, I think, being the most interesting results of that study is that people who invest early in a systematic active portfolio that's close to the market, but taking enough deviation to have some outperformance, it can just lead to massive benefits. So the 15 to 20% numbers that we share, it's basically for someone who starts at 25, makes contribution to an account until 65. The difference between being invested in a market portfolio and a systematic active core like construction, that's where this number comes from. So again, it's pretty economically substantial. If you expect to have 1 million under market, you expect to have an extra $200,000 with the systematic active. And I think the significance of the results for both wealth advisors, DC advisors, even institutions and endowments is that you can take a little amount of tracking error relative to the market, just have a reasonable, moderate level of exposure that people are more likely to be able to stick with long term. And that is enough to move the needle significantly across the life cycle. So, no matter whether you're a younger participant or investor saving for retirement, or whether you're a retiree trying to sustain your spending, it basically the study shows that it will benefit you to go for more of a systematic active core like construction rather than pure market indexing.
Well, let's dig into the study a little bit. An advisor who wants to deviate from the broad market index and or from bond funds has many options, and they can go towards active management. They could go to alternative assets like private equity that you just mentioned. What makes size, value, and profitability unique compared to all the other alternatives?
I think there the strength of the evidence is in a class of its own. So first of all, these things all have a theoretical rationale for them. So, for instance, in the case of value, it makes sense that stocks in general have different expected rates of return. We wouldn't expect the thousands of stock in the US market to all have the same expected return. And we know that just as a matter of pure accounting or algebra, if you have two stocks with similar expected cash flows and one of them is cheaper than the other, then the only way that can be true is if the cheaper stock has the higher expected rate of return. Now, of course, there's the empirical component of showing that you can identify those stocks and pick them apart. But the theory is there. And I think that's something that's very powerful because those kind of theoretical statements, they're very general in nature. They don't require a ton of assumptions. We just start from the fact that an asset is a sequence of discounted cash flows, and you can kind of find the intuition for those premiums. So I think that's number one. But number two, I think, and perhaps even more important, is just the strength of the overall evidence. So the kind of the one of the landmark papers was the three-factor model paper in 92 or 93 by Fama and French that found that value and size were additional drivers that explain stock returns. But what's interesting is after that, they looked at the U.S. sample over 30-ish years in U.S. history, but you had out of sample tests after that. You had international tests, and there the premium is there as well. You had an out of sample test back in the past, extending the data after the original study was carried out, all the way back to 1926. So these kind of out of sample tests, they ensure that it's not just data mining or kind of a fluke, a statistical fluke, but something that's likely to be a constant across periods of time, across different regions. And the other nice thing about size, value, and prof when it comes to implementation is they're very robust. Dimensional, obviously, we have opinions about the best way to pursue those premiums. But the truth is, if you use pretty, for instance, again, going with value as the leading example, if you use pretty much any reasonable metric of relative price, it's going to yield a premium, essentially. So that tells you that the underlying phenomenon is not flimsy, so that if you don't do it in a certain specific way, it's going to break down. There's a kind of inner robustness to it that gives you confidence that it's easier to pursue. And the last thing is, with all these strategies, obviously there's a track record, both dimensional and other asset managers, of implementing them. It's again using public securities, very transparent. So there's a kind of combining all that, there's a theoretical strength to it, there's the strength of the empirical record, and there's also a practicality. It's just very easy to implement an investment solution that's cost efficient, transparent, all of that. So I think that's what really makes a systematic active equity stand apart when you look at the options on the table that you have to increase returns.
I get it, but broad market indexing is very compelling. It offers broad diversification, incredibly low fees, it's very transparent. How would a portfolio with the what you're calling moderate emphasis on price, size, and a value size and profitability compare to a broad market index, not just in terms of performance, but in terms of cost? I mean, there's going to be an additional cost that will exceed the few basis points that it costs to pursue a broad market index. Does the cost of those compare, and can it be done with a dimensional ETF, or is it only available to mutual funds that are offered through dimensional advisors?
The kind of core solution which we use in the paper as benchmarks, obviously it's going to work no matter the wrapper that you choose. So whether it's a separate account, whether it's a mutual fund, whether it's one of our core ETFs, you would expect the strategy to have the same basic properties. So definitely the range of vehicle that's available is pretty wide. In terms of broad market indexing, it's important to note that obviously it's very compelling because of the history behind it. What led to indexing being so popular is the realization that traditional active stock picking was not doing very well. It was extremely costly, both in terms of the explicit fees and the performance. So I fully get that indexing has been a huge improvement over that, and that it's even today it's a very good starting point. But I think there's been almost the pendulum went a bit maybe too far in the other direction. What happened is we went from having pure stock picking to saying any deviation from the market portfolio is wrong or somehow not justified. And I think the main insight that we have to keep from the shift to traditional active to indexing is that relying on market prices is the big lesson, that instead of trying to outguess the price of individual securities, that you're trying to harness the information that's in the market, which is what indexing is doing. You're looking at the market cap weights and you're following that. But it doesn't mean that all stocks have the same expected returns. And it doesn't mean that the market can send you signals about the relative returns of these things. Um, so I think that's where systematic active takes the best of indexing. You can have a portfolio with thousands of names, broad diversification, market weights that don't tilt too far out compared to a market portfolio, but then bring back some of that exposure to drivers of expected returns which aren't based on an intuition or a whim, but rather that are backed by a solid track record and evidence. So I think that's the way to think about systematic active versus indexing. Indexing was a big improvement over traditional active, and then systematic active is again taking the best of indexing and adding a little bit of a twist to increase performance or expected performance further. Important consideration: the fees, as I mentioned, are much lower. I think systematic active solutions, they're in the same ballpark. They might be a little bit more expensive, but again, typically they will incorporate not just the targeting the premiums, but also other things like having flexible trading because you're not tied to an index. So I think the additional cost is fairly reasonable relative to those value adds.
You use the phrase moderate emphasis when you refer to the tilts that would be applied to value size and profitability. What does moderate emphasis mean? how should advisors and their clients think about using this research as they plan for retirement?
In terms of the amount of emphasis, one example is if you think of the broad market as being 90% large cap and the smallest 10% is small cap, the index that we considered in the paper would have something like 15% in small cap. So a 1.5 exposure. We're not talking about twice or triple, just an amount of tilting that is enough to generate a difference in returns and some outperformance. But the flip side of that is that instead of having 90% in large cap, you have 85%. So you still have the bulk of your portfolio that's going to move very much in sync with the market. So that's one characteristic, but it's kind of a similar logic when looking at the value and the premium exposure. In terms of the implications of the research, I think, as I repeated, something that's very important is this applies across the life cycle. So one of the findings of the research is that you can benefit in terms of accumulating more assets, sustaining your spending, and even leaving a higher bequest behind. So again, you can use that in a client portfolio at different stages of life. In terms of applying it, again, as we mentioned, core solutions that instead of having different components portfolios pursuing different premiums, it's just one big integrated thing that can be a very beneficial way to implement that. But some advisors, for some reason, they might be more comfortable or have restrictions that lead them to combine a market portfolio with other component portfolios. So there, I think the results of the study would still apply, that a moderate amount of emphasis, so something like, I don't know, 90% market and 10% small cap value, for instance, that might have a beneficial effect on the client's allocation. Well, what I think is the key message, and that's why we chose a core portfolio with a moderate level of tilt, is that it can pretty much substitute for any equity allocation. Because again, the moderate amount of tilt makes it behave not too far off from an index, which makes it just that much easier to fit into a portfolio or just a client's asset allocation. And again, talking to advisor, there's a big psychological aspect to it. So it's easy to talk in the abstract about the philosophy, the empirical record. But when returns are not going your way, it's much tougher to stay in your seat, and that's a big part of it. So there's no way to eliminate that problem fully. There's no free lunch. If you want the higher returns, you need to be willing to endure periods of short-term underperformance once in a while. But the thing is, you at least make the problem smaller to a place where more people are able to tolerate it and stick around for the long run. So I think that's why for most people, probably a more light to moderate amount of tilting is going to be most helpful to them. And what the research shows is that moderate exposure is powerful enough to generate substantial benefits at all stages of life.
Let's pause for a couple of minutes for a word from our sponsor. I know that you already enjoy our content from advisor perspectives every day. So why not use our award-winning articles, commentaries, and charts to streamline your communications with clients and prospects? My team and I introduced AP Premium last summer, and we've been blown away by the response from the advisor community. Keep listening for an exclusive code to get $10 off our premium service. You won't find the in-depth, sophisticated market analysis and charts like Advisor Perspectives anywhere else. This information can be invaluable to help your clients understand complex topics. Let's say a client asks a question about their estate plan. Instead of spending time researching and drafting a long-winded response, quickly grab any number of related articles from our library and share it in a personalized way. AP Premium gives you the power to add your logo and a personalized message to any piece of content and share it directly with your clients and prospects. We also introduced a premium offering called the Ask an Expert webinar series. At our inaugural session, we were joined by Wade Pfau for an intimate Q&A. Advisors have told me this is one of their favorite perks of being a premium member, and we can't wait to share who's slated to join us next. Give Premium a try and see for yourself why it pays to be a premium member. As always, we appreciate your support of our efforts to bring excellence to financial journalism. And as a thank you, I'm offering a one-time $10 discount for new premium members to be taken off your first monthly or annual payment. Just go to advisorperspectives.com/member. That's advisorperspectives.com/member and use the code podcast 2022. That's podcast 2022, all caps, at checkout. And now back to our podcast. You mentioned that this applies at all stages of life. Talk more about how the research would apply specifically to investors who are approaching or are already in retirement.
The research looks at people over the entire life cycle, but we kind of broke it up in part. So there's a phase of the results, which is the accumulation phase. What happens there is obviously if you have that systematic active exposure, you tend to enter retirement with more assets. But then the other side of that is, okay, suppose that you have two people, they enter retirement with the same pot of money. So we kind of ignore what happened before, and they just spend according to a 4% rule for 30 years. So again, something very standard, kind of a proxy for trying to have a smooth standard of living. And again, one of them is in a market portfolio, the other is in a systematic active solution. What we found there is that there's a substantial reduction in failure rates. So the chance that you will run out of assets early before 30 years. And that's one of the big benefits of the systematic active approach, is that even if you come to that form of investing later in life, there's still benefits for you. It's not just about growing the pot of money, but even when you have a structure of cash flows or spending that kind of interplays with the investment piece of it, I think the simulations were very helpful in demonstrating that there's a big benefit there. And also for a lot of people, obviously in the wealth advisor community, succession planning is an important variable as well. As we mentioned in the introduction, for people who want to leave something behind to their children or again to charities or things of that nature. First of all, if you don't run out of money early to sustain your spending, by definition, it means you have some money left. So you're more likely to have something to leave behind. But also, when we look in the paper at scenarios in which investors have enough money to sustain them through retirement, we found that the systematic active versus the plain market led to a pretty big increase in the bequests that you leave behind as well. So again, it's something that applies at all stages of life. Even if you come later to that form of investment or your clients come later to it, they can still reap benefits.
We've published a lot of articles on quantitative or factor based investing, or what you call systematic investing. I've done many podcasts on that topic. So I want to ask at least just a couple of questions that have consistently come up in those discussions. We'll start with the fact that, of necessity, factor strategies are based on observing patterns that have occurred in historical data. What assurance can you offer that the future will resemble the past?
Well, that's where it's very important to go back to what I mentioned earlier, the theoretical rationale. So, what happens with a lot of data mining or kind of back tested quantitative strategies, especially the black box version of those, is you don't understand what leads to the excess returns, really. In that case, we understand the source of the returns. There's a rationale for it that's evergreen. So, stocks, unless all stocks in the future have the same expected rate of returns, which I think is very unlikely to happen, then there will be room for strategies that try to identify those differences in returns using kind of simple variables and then to benefit those differences. So that's the first insurance against this thing not working in the future. Just that securities, just like different kind of bonds have different interest rates, different kind of stocks will have different discounting rates applied to them. So that's one insurance. The other thing is, even when I mentioned all the out of sample testing before, that this has been tested in different regions back in the past and even in the future, what's important there is that it doesn't provide you a totalizing explanation of why value exists, why profitability exists, and things of that nature. But it makes it more likely that what is causing these factors to be so kind of pervasive is something that's deeply rooted, that it's not specific to one region, it's not specific to one period in time. So I think that's another point that gives you confidence that this thing will persist in the future, meaning the higher expected returns associated with the premium. So there's no guarantee that they'll be exactly like the past. Maybe they will behave differently, but my personal opinion would be that the baseline scenario is that we have no reason to expect them to be vastly different than the past.
These strategies have been known since 1993 when Fama and French published the research that you mentioned earlier. Even if I accept the theoretical basis for these strategies, and even if I accept the fact that you have valid out of sample tests, how do we know that if investors put enough assets into these strategies, the advantage won't go away? How do you measure the effect that asset flows have on the advantage that these strategies have historically offered?
Well, one of the big things that's important to note is we see no evidence of that happening. Basically, if the smart beta industry or the rise of these factor ETFs was there is a standardized, agreed upon set of factors that everybody is piling into, I think that would be maybe a bigger concern. But what's happening is that everybody's got their own version of the factors and they're looking at different factors. So maybe one firm is emphasizing value, but one other firm, because they're doing more quality or profitability sort of stuff, they're piling into growth stocks. So if I recall correctly, we even put out a blog about this in the past, where what's happening is that the money that goes into those strategies, it's not like it's piling into a specific factor, but it ends up being scattered all across the market. So if that effect is approximately neutral, then basically, I don't think it would be a big concern that the difference in returns is going to shrink too far. And again, the other thing is basically for that thing to become the case, that there's no difference in returns between stocks, you would need people to discount them all at the same rate. But I think as long as stocks have different amount of exposure to systematic risks, that gives you a guarantee that there will be meaningful differences in discounting rates and that the strategies will be able to exploit that.
Value notoriously underperformed growth starting about the time of the financial crisis, I think in about 2007, right up through the pandemic in 2020. Value did well for a while, then growth came back. But there was a period of roughly 13, 14 years where growth outperformed value. How do you explain that long drought for value investors?
I think the main explanation would be noise. I don't think that there's a kind of robust explanation in terms of, say, tying into macroeconomic indicators or things of that nature. And what we find in our research is when we try to poke around and see, is there something that correlates with the equity premium, the value premium, all those premia, whether it's changes in interest rates, whether it's changes in GDP, what we find is that it tends to be pretty noisy, that at least the macroeconomic variables don't seem to predict the behavior of the premiums a lot. Um, I think basically that the simple fact of the matter is just randomness. Once in a while, it will lead to these kind of long term sustained droughts. I think maybe this is not a widely shared sentiment, but I think it's almost comforting in a way. I would be very worried if you go back to your last question about value subsisting in the future. If it gave you 2% like clockwork of outperformance every year, then I would be okay. This is not risk, or this is not something that's sustainable. That's almost like an arbitrage. So I think the fact that it does have these period of long run underperformance, that tells you there's probably a risk in there. And again, that goes back to what we look at the paper inside the paper was, okay, we just had one of the worst runs of value in history. What would most investor have been able to stick with during that period? And the core one construction we looked at, I think I looked at different periods, but suppose the market had a compound return of 8 or 9% during that period in absolute terms, and you're lagging behind by, to use a round number, something like 50 basis points. Like, it's annoying for sure, but it's unlikely for most people to kind of derail their financial goals or their overall trajectory. So again, it's a couple of remarks all over the place, but the short answer is I do think that it's a property of any strategy that's going to be sustained in the long run, that there's going to be periods of underperformance, a risk. And the other piece of it is it's kind of baked in the design we looked at this study. Of course, if you're 100% in small cap value, that's a different story, but most people don't do that. So with a balanced allocation, I think people can stay in their seats and gain the long run benefits.
Americans are materially undersaved, particularly when it comes to their defined contribution plans, their 401k plans. Do you see the premium exposure to value, size, profitability as something that can help make the most of the savings that participants have in those plans?
Well, I have to preface this by saying it's not a silver bullet. So, there's a number of reasons why people under save having to do with maybe financial education, people being constrained. Education's expensive, healthcare is expensive, so housing's expensive. That's a big one too, for especially for younger people. So obviously, it's not going to be a cure-all that's going to solve everything, but the results do show that, especially if you start early and stick with it consistently, that kind of systematic active equity investing can give you maybe an extra 15 or 20% at retirement. So if that's an extra 50 grand or extra 100 grand, maybe that won't be enough to fully fund everything, but it does make the best out of a tough situation. And again, that's something that's a bit near and dear to my heart, because I come from a family of union workers who used to be covered by the old school DB pension. And I have some of my younger relatives who had their pensions given to them as a lump sum because these things were kind of getting rolled back. And now they have to do their own money management, basically. So I see the impact that it has. And, I think it's one of the levers that DC advisors can pull that's going to help people meet their goals. And it's something, again, that's widely applicable to a broad class of investors.
If there's one key takeaway that you'd like to leave with our audience of financial advisors about the questions that they should ask before allocating to a quantitative or factor based strategy, such as what you're recommending, what would those be?
Have a rationale for it. Doesn't need to be a fully fleshed out academic theory, but there should be something robust underpinning all of this. Look at the evidence, and especially when you're evaluating managers, be very insistent on real world implementation. Can this thing be implemented with low trading costs, with transparent solutions? Because when things go poorly, you want to understand, okay, I have a portfolio that's invested in value did poorly, therefore that's why my portfolio is lagging behind. Things that lack that kind of transparency, they're hard to monitor in the long run and make adjustments. I think steering clear of that is probably a good idea. So again, low cost, transparency, and just having a track record as well, in especially in terms of managers, not just in one type of funds, but if you have the whole track record over asset classes, that's a big one as well.
Well, we will include a link in the notes that accompany this podcast where you can learn more about Mathieu and what he's done. There'll be a link to the paper that he wrote, How Targeting Size, Value, and Profitability Can Improve Retirement Outcomes. Mathieu, is there anything else you'd like to add?
No, thank you for having me.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopsher. Today featuring Mathieu Pellerin of Dimensional. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.